Hello, I'm Bryan Wroten, Senior Reporter for Hotel News Now. I'm sitting here with Leeny Oberg, EVP and CFO of Marriott International. We are at Alice on day 2. Thank you very much for joining me here.
Sure, it's great to be with you, Bryan.
Thank you. So, wanted to talk to you, find out a little bit what your thoughts are on 2017 highlights from Marriott. That was your year of growth. If you could share a little bit of details about that for us.
Sure. I think we are particularly pleased with the combination of the success that we had in integrating the acquisition of Starwood and really making great progress there, but also with our business as usual. So in addition to strong performance at the hotels and with RevPAR growth around the world, we also were able to make just terrific strides in adding even more rooms to our pipeline. So as you've heard, that we've added another 125,000 rooms to the pipeline through our signings in 2017, and it really a terrific representation of our brands around the world.
So can you go into a little further detail about some of the growth trends in the different segments in Marriott?
Sure. What's been really rewarding for us is to watch the continued strength of our luxury pipeline. If you look at the hotels that we have either open or under construction, we basically have our number is bigger than the next 4 competitors combined when you look at the luxury portfolio, and that's around the world. So the demand for those brands is terrific. And then we've also hit a record for select service signings around the world. And the growth in the select service portfolio outside the US is particularly encouraging as we look at the strength of those 11 brands.
So looking at the integration of Starwood, I know it's been a plan of Marriott's to, over time, sell off some of the owned assets from Starwood. Can you tell me a little bit about how the program has gone so far and then what is remaining from that? Sure.
We've been able to, through literally just about today, we've sold about $1 billion of real estate, of hotel assets. And in addition, we've actually recycled almost $200 million of loans that we've made into hotel projects. So since the closing of the acquisition of Starwood, it's about a total of $1.2 billion of asset recycling, with the thought that we can get another $300 million during the year 2018. And although there are a few assets like a hotel in Rio, for example, that could be hard in this environment to sell, there's plenty others for us to liquidate and feel like we can get them into great hands of other hotel owners with strong management agreements for us to have terrific brands, hotels in our portfolio.
So speaking of 2018, can you share with us some of the budgeting priorities that Marriott has for the year, and maybe a little bit of color on what the recently passed tax bill will mean for Marriott?
Sure. As you might imagine, first and foremost, it's about going after our top line. And our top line is driven by 2 fundamental items, RevPAR growth and rooms growth. So it is all about making sure that we continue to add great hotels to our system and then get them open, as well as continuing to try to gain market share in the revenue line around the world. So we look for that. And then it's about trying to bring those revenue gains down to the bottom line. And that includes everything from running our hotels more efficiently, so providing margin synergies through driving operating improvements in the hotels, but also G&A synergies. And although we've made terrific progress on achieving the G&A synergies that we want from the Starwood acquisition, we're still not quite there yet. And we do expect to hit the magical $250 million number in 2018. And then when you think about from the tax reform side, the reality is about 2/3 of our business is in the US. So clearly from that perspective, when the federal tax rate on profits in the US goes down from 35 to 21, that is of course tremendously positive for us on that business. But I think probably the more important question is really how it affects the overall economy. when you think about what drives our business, at the end of the day, it is about GDP in the country where our hotels are located. And so the real question is does this tax reform, although it's clearly going to provide a bunch of cash, is what it means that there is accelerated economic growth in the U.S. And that, at the end of the day, is what will drive our business the best and will be the most sustainable kind of growth.
So looking at 2018 going into 2019, obviously you're looking at further growth for your footprint. Can you talk a little bit about Marriott's role in working with owners and developers for further acquisitions, for their new construction, for their conversions?
Sure. Well, as you know, in general, we don't own the hotels that we either manage or franchise, but we do, however, participate and invest capital where it is particularly helpful to an owner for whatever reason, whether it is in the form of something like a debt service guarantee to make sure that the owner has access to good capital to build the hotel, where we can help provide that, and as part of it also get a strong management agreement. We do that, and I would say that typically for us that is in the ballpark of $300 to $350 million a year goes directly into a large number of deals to help work with the owner to get those deals on board.
Well, thank you very much for joining me here. It was very nice meeting you.
Nice to meet you too. Thank you, Brian.
Thank you all for joining us. Stay tuned to Hotel News Now for further coverage from Alice.